Good morning, everybody. You're all very welcome to the first webinar in our series on building blocks for scale. My name is Tom Early and I lead the funding and scaling solutions team within Enterprise Ireland, the goal of which is to work with our clients to help them access appropriate sources of funding to scale their business in a rapid and sustainable way. Access to funding or access to finance is one of the most common reasons cited as to why a company does not achieve scale. The reality is it's a lot more complex than just lack of funding. This webinar series is aimed at founders to provide practical advice on how to effectively prepare their business to scale rapidly and source the most appropriate funding based on their business need. So the topics we're going to cover are today's session, growth pathways for scale-up companies. Next month's session, the importance of planning to achieve scale. People, culture, and retention. It's essential for your scale-up. Then the next session, corporate governance and the need for a board and why you need them to scale. And then the last session will be on obtaining funding for scale. Now, these are all 5 short 45-minute sessions to highlight areas for consideration by founders when scaling their businesses, and to listen to the experiences of other founders who have successfully achieved scale. They follow the same format: an expert speaker in the area and an interview with the CEO who has actually lived through the topic we're talking about. We're recording this and we will post the link up after so that you can access it again. But look, let's go back to today's topic, which is growth pathways for scale-ups. So I'm going to be joined by Professor Jonathan Levie. He's the Professor of Entrepreneurship and Regional Development and co-founder of the Center for Entrepreneurial Growth and Scaling in NUIG. And he's going to take us through at a very high level the building blocks you need to put in place when you're rapidly growing your business. Then we're going to be joined with an interview with Nick Keegans, co-founder and CEO of Mailmetrics. Mailmetrics is a technology platform that helps financial service companies to digitally transform their customer and regulatory communications. It has experienced rapid growth in recent years, which has led to the company being ranked as Ireland's second fastest growing technology company in 2022 in the Deloitte Fast 50 Awards. And Nick's going to share his experiences of how he's handled that growth. So I'm going to stop talking now because it's more important that you listen to my speakers. So I'm going to invite Jonathan to come on and I'll turn off my mic.
Thank you, Tom. Hello, everybody. I'm just going to get my slides here. Right, so as Tom said, my name is Jonathan Levie, and I'm the co-founder of the Center for Entrepreneurial Growth and Scaling in the University of Galway. And I'm going to bring you through a sort of fairly high-level introduction to scaling to sort of set the scene for Nick's talk in just a few minutes. So if we get straight into it, I'm going to assume that you're the CEO of a first-time CEO of a scaling business. So let's just first of all check that you're actually scaling. One of the things that we find in talking with CEOs of scaling businesses is that quite a few of them, when they look into it, they realize that they're not quite scaling yet. So if you haven't yet achieved product market fit, if you've not got recurring revenue yet, if you're still searching for a viable business model, you're really still in startup mode. If you're growing by about the same amount each year on average, that's growth, but it's not scaling. So scaling is a particular type of growth where you're producing exponential increases in outputs. So that's quite different from the steady sort of growth that we see with a lot of businesses. So that exponential growth carries a lot of implications for the way you run the business, and that's what we're going to look at now. So I don't know whether you know, whether you've heard of Scale Up Nation. They're a Dutch company that do a lot of work with scale-ups, and they have some nice ideas on what has to change in order to for a startup to scale. And the two concepts I'd like you to think about here are, as well as exponential growth, are internal transformation. So there's a number of ways in which you need to transform the business in order to be able to grow exponentially. And one is moving from sort of founder mentality to a CEO and management team mentality. A second one is moving from being a team or thinking of yourselves as a team to thinking of yourselves as a company. And then moving from first to recurring revenues. I've mentioned that already. The next one is from projects where you may be doing, customized work for one customer after the other, to processes. And then moving beyond the first product to having an innovation pipeline of products and services. And then finally, from local to international. So that's a lot of things to be doing all at the same time. I'm going to go into that in a bit more detail in just a minute, but just let's look at what exponential growth looks like. So here's the kind of the big daddy of them all, Amazon. It's had two scaling phases in its life. The first was before 2000. Then along came the dot-com crash. They let go about 15% of the workforce and then took off again. And up until last year, they'd been scaling for about 20 years. It's quite extraordinary. But they haven't just been scaling their outputs, their revenues. They've also been squeezing more outputs out of each unit of input. And that's what I've got on the right-hand side there. And that's part of the trick with scaling. It's not just about scaling your revenues. It's also about getting more outputs per unit of input. So let's go back to this internal transformation. And why do you need to transform the business? Well, a major reason is that there's kind of a basic law in information networks, which says that connectivity scales superlinearly with network size. So that means is that as you take on more people, the number of connections doesn't just increase, but it increases exponentially. That could cause problems for you as a CEO, depending on the way you interact with your employees. So let's just take a look at an example here. On the left-hand side, typical sort of startup situation, you've got, say, 8 direct reports. But what happens if you double the number of direct reports and then double it again? You end up with 32 direct reports. Can you see the problem here? You're getting lots of information coming in and you get information overload. And the danger with that is that you may miss things that are really critical. I don't know whether you spotted the snake there among the pile of leaves, but that's just a metaphor for the danger of overload. So of course you have to transform in this case, the structure of the business. If you'd like to learn a bit more about this, there's 2 great short little Harvard Business Review online articles. One is called How Many Direct Reports? And you can do a self-diagnosis. And the other is from some Finnish researchers on how to successfully scale a flat organization. Okay, so how does scaling work? So we're going to try and open up this black box of scaling. What happens between the inputs and the outputs? The inputs and the outputs are fairly straightforward. So the outputs are increasing revenues and profit potential. And you know what the inputs are. You need a big market or potential market that you may be creating. A unique bundle of technology. You need funding, which Tom mentioned. And maybe some other things, but the most important are the people. So the core of this sort of black box is excellent people. And I think right now is a great time to find some excellent people who are experienced serial scalers, we call them. So they may be functional heads. There's a lot of far-known firms that are letting people go at the moment. This could be a good opportunity to pick up people who have been trained in scaling in these far-known firms. So what else do you need? Well, those serial scalers may help you to develop the excellent processes that you need, the standard operating procedures like onboarding and what people have to do. And to help them do that, they need measurable systems. So you get the information you need in a digestible form so you can watch your KPIs. So these serial scalers often know what the best systems are, and they're probably very different to what you may have used in startup mode. So for example, a lot of people still use in startup, say Excel for your CRM system. That's just not going to work when you're scaling. The most important of all is culture. And, you know, a lot of CEOs wince when we start talking about culture, but the serial scalers don't. They keep coming back to us in our interviews to culture. They say, you know, the softer stuff is the most difficult. So very quickly, 3 things to maybe take away on culture. The first is you as the CEO really need to set the direction. You need to describe where we're all heading to and the values that we as employees need as a guide to make the right decisions. Secondly, you've got to get them all on the bus. And there's a sort of rhythm or a cadence to doing this. And then thirdly, you really want to get to the stage where employees will tell you that they don't have to wait for their manager to tell them what to do. So culture is really critical, and you'll hear more about this in the weeks to come. So this acts as a flywheel to scaling. Very quickly, why are we talking about scaling now? Well, it's made much more possible by digital technology. So all these drivers of scaling are enabled or turbocharged by digital scaling. Things like economies of scale, of scope, learning economies, and what the economists call positive network externality. So this is where, you know, the more people who use your product, the more valuable it becomes to them, sort of like LinkedIn. So that's a very quick run through of the sort of emergent model that we're developing in the center. And I'm going to hand you back to Tom, who's going to take you through to Q&A.
Jonathan, thank you so much for that. It's actually really, really interesting. So I might ask Nick to come on screen now. And Nick, I got to say thank you so much for joining us today. I understand it's super early where you are, and you're giving up your time to share your experiences. So it's really appreciated. Yeah, good. Well, I'm going to start off with something that's nice and easy for you. I might just ask you to talk to us a little bit about your business and what it does.
Sure. Well, I think you gave a pretty good introduction earlier on, but Mailmetrics has developed a technology solution to help highly regulated financial services companies such as banks, insurance, pensions providers to outsource and then digitally transform their customer communications. So a lot of these organizations have been with us for a very long time, and they operate on old, outdated legacy systems, which restrict their ability to provide really slick digital experiences. So Mailmetrics has developed a technology solution that sits in between their old legacy systems and their customers and provides the ability for them to move all their customer communications online and provide a really good experience in the process.
Oh, good. And as I understand it, you have been growing quite rapidly over the last while. So let's see, there was like, you had 40% per annum for about 3 years up into 2020. And then even in the last 2 years, and I was just chatting to Shane, your CEO there, our CFO there the last day, he was telling me that you've achieved nearly 1,000% growth in terms of your sales. So you might just take us through how you managed to do that. How did it come about?
Yeah, so as you mentioned, we've been growing 40% year over year organically and continue to do that to this day. But what we have used in order to fuel our growth is acquisitions. So for us, we're selling to really large financial services companies. There's not that many of them around there, and they're quite slow to move. So the sales cycle is very long and drawn out. It can be 24 months in some cases. So for us to continue growing as fast as we wanted to grow, we couldn't just rely on organic growth. So what we essentially do, because we're providing digital communications to companies that are relying heavily on postal communications, we have started to acquire print and mail businesses that print and mail letters for banks and insurance companies, we acquired these businesses, onboard them onto our software, and digitize them essentially. So a lot of that growth has come through finding acquisition targets and completing those acquisitions.
Oh, how did that come about? Was that like, forgive me, was that just something that just happened? You were like, it was an opportunity, you just went, oh my God, yeah. Or was this like you sat down, you planned, you actually went, okay, I need to do this now. Like, was it intentional, I suppose, or just something that happened?
Initially, it wasn't a grand master plan or anything like that. We were partnering with these businesses. So we would go to tender, we would secure an insurance company, for example, as a client of ours. And we would do all the digital communications, and we would give the printed communications to a partner, whatever was left over after we had done the digitization exercise. And what we realized actually was a lot of the companies that we had on our target list that we wanted to acquire as customers were customers of our partners. And we were thinking, Jesus, if we just had access to these customers, it would make our life a lot easier. So initially we acquired a partner of ours that was very successful. And we've just continued to do that, acquiring other companies in that industry in Ireland, the UK, and hopefully now further afield. So,
okay, so scaling your business like and that rapidly and taking on other businesses with other cultures, as you just heard Jonathan mention, I mean, that's got to have had some pretty serious complications for yourselves. So maybe you might just talk a little bit about them and how you handled them.
Yeah, so it hasn't been easy. I think to touch on what Jonathan touched on earlier on, when you're growing organically, things kind of break progressively over time. You have a lot of time to react and respond, and you kind of get a bit of foresight as to what's coming down the track. When you go from 20 people to 110 people a year later, a lot of your processes and systems just fail, and they don't scale very well. And so you often find yourself playing catch up a lot of the time.
Yeah.
So we really had to essentially start from scratch and redesign a lot of our internal processes and systems. As Jonathan mentioned, when you have a team of 20, you know everybody, you know every project, you know what's going on. Whereas when you get to 100 people across various different countries, the level of complexity just goes through the roof. So we had to design essentially and introduce an operating system to ensure that everybody in the business was on the same page, that we were hiring and firing based on culture and values, and that we had really defined processes so that no matter where you are in the organization, no matter how far you are away from the senior leadership team, we're all sort of operating in the same way.
Oh, fantastic. I might just actually remind everybody that the Q&A session is going to happen at the end. So if you want to post questions in, Owen is going to consolidate those questions and come into us. So Nick, sorry, back to you, because I find all this fascinating. Like, there's got to be every sort of headache going through your book. But maybe particularly because of my background and where I'm looking from, you might just talk to me about your financing journey. Like, how did you go about funding this? Because I got to imagine it's quite expensive to start buying companies and take them on board.
Yeah, so I suppose our funding journey started 10 years ago when we started the company. So we would have took on some angel investors to give us the initial capital just to start to build out the first iteration of the product. Once we got to a certain point, we then did a second round, like our actual seed round, whereby we got high potential startup funding from Enterprise Ireland. So thanks very much for that, Tom.
Yeah.
And
I personally gave it to you. Yeah.
Absolutely. Yeah. And so that gave us, we raised about 700,000 euros in seed capital to enable us to actually to build out a product that we could go to market with. From that point up until 2021, so about 2014 to 2021, the initial seed capital that we had raised gave us enough funding that we could bootstrap the business to profitability, essentially. So we had taken on no external capital or no external equity from 2014 until today. When we decided that we wanted to make an acquisition, I suppose similarly to the question you just asked, I was trying to figure out myself, how am I going to fund this acquisition? So it was a lot of speaking to other CEOs, other founders who have done financing rounds, speaking to various advisors. We went around to all of the corporate finance advisors around town, just to put the plan in front of them and to try to understand how they could help us to raise the funding. Ultimately, what I did is I took on a CFO. So you mentioned Shane earlier. So Shane Woods is our CFO, and he had worked in corporate finance in one of the large firms in town. So Shane essentially came on to help us to raise that funding. And for us, because we're buying businesses with recurring revenue and they're profitable businesses, we made the decision that we were going to acquire those businesses using debt financing. So instead of taking on an equity partner to help us to do that, we used bank funding. So initially, because we were a small organization and we needed kind of certainty of execution, we use an alternative lender. So that's debt that comes in with a much higher interest rate than your standard pillar bank, but much more flexible repayment terms and like a flexible amortization profile. And then after a year, we got to the point where the business was large enough and we had proved our model and proved our profitability and our revenues and so on and so forth, that we were able to refinance out of that debt with a pillar bank. So at the moment, we're funded through Bank of Ireland and just a regular pillar bank.
Okay, that's actually fantastic. Just you mentioned something there, and it goes back to the acquisition strategy part of it. Like, have you developed your own process for how you handle each of these, onboarding each of these different companies, or is it a case of each time when you're doing your due diligence of the companies, you figure out your approach to how to merge them separately? How do you go about that?
We kind of learned the hard way that we need to try and standardize that as much as possible. Okay. So I think we were probably a little bit naive with the first acquisition, and it didn't go as smooth as it could have, let's say, the integration side of it as a result. So when we find these companies, we're buying the same type of company every time. So they're competitors of one another. So they're very easy to compare one against the next. So we would outsource like tax and financial diligence to the corporate finance advisors. But we will then do our own operational diligence, where we're looking to see how these companies run, how they service their customers, how they deliver their product or service. And what we're working on now is we've created a new function in our organization, which is acquisition integration function. And that has an individual who will run that function as the head of acquisition integration. And we're trying to develop a blueprint, essentially, whereby like no acquisition will be the same as the last, but they have a lot of commonality there. So how can we develop a blueprint so that if one of our main drivers for growth is acquisition, that we can make one after the next, after the next, after the next, and go through a very standardized process so that we can acquire them and integrate them as quickly as possible.
It's fascinating. That's a really good way to go about doing it. I just want to skip back to your funding journey before. Like, when you sat down initially and you started this, did you say, okay, this is going to be my funding journey? I am going to just raise angel. I'm just going to do this, and then I'm going to bootstrap, and then I'm going to seek bank funding, or like, did you have different plans? And then what made you change along the way? How did you come up with it, for want of a better word?
No, we didn't think that far ahead, to be honest. I think when we raised the seed funding, we thought we would have went through what could be seen as a very typical kind of startup funding road, where we raise seed funding, then we raise Series A, Series B, so on and so forth. We're lucky that our customers are large and our contracts are large. So although they're sort of few and far between, so you don't win a contract every day, when you do win one, they're quite substantial. So our first contract win got us to a point where we were generating enough revenue that we could see a road to profitability without taking on external funding. And then we essentially just decided to grow organically. We kind of didn't focus on our next financing round for a very long time after our seed funding. It was only when we got to a point where we didn't have enough cash flow in the business to do what we wanted to do, that we decided to take on external funding, whether that be through equity or debt. So when we decided we want to make an acquisition, we didn't have a war chest. We didn't have enough cash on the balance sheet to say we're going to acquire this business ourselves, that we then need to start to reassess our funding options.
Okay, so I'm actually getting a lot of questions coming into the Q&A there now, and I'm going to answer some of those in a session. But there's one thing that you sort of talked about loosely that I wouldn't mind just understanding a little bit more, and I suppose, right, sometimes, and this is the problem I see sometimes for founders. So let me give you a bit of background to my question, right? So sometimes with founders, they don't know what they don't know. And you know, and you scaling, they might be missing a whole piece. So you mentioned there before about how you were setting up a whole new function to do the integration piece. Like, how did you go about educating yourself to figure out I'm actually missing this chunk of my business? Like have you gone and sought advice from other people? Do you have mentors? Like what is it that you do? How did you sit down and figure this out?
Yeah, so that we did a course last year, an Enterprise Ireland course called Leadership for Growth. And on the Leadership for Growth course, you're assigned a business mentor. Yeah. And the business mentor kind of helps you to work through some of your key business challenges. And for us, one of the biggest challenges that we had was, you know, how do we integrate these acquisitions in a way that's, you know, efficient? And through working with that individual, Mike Hensey is his name, he helped us to just kind of realize that, look, if acquisition is going to be a key focus for your business, you can't leave it up to other functions in the organization to integrate these companies alongside their other day-to-day responsibilities. So just through working through that exercise, you know, we sort of had the moment of realization that, look, we really need to create a speciality in the company just for managing acquisition integration.
Okay. And look, last question from me.
Sorry, if I just had one more point on that, Tom, if I may. What we've also found really useful is find other companies that are growing in the same way as you are. So we've found a lot of other businesses that are growing through acquisition, and we've kind of latched onto that and shared our experiences. And you'll find companies that are maybe a year or two ahead of you who've experienced all the problems that you're experiencing now. And generally speaking, I think you know, companies in the community here in Ireland are very open to helping and sharing. So that's just a bit of advice I'd give.
Actually, that's a fantastic piece of advice, and actually, it's one that we in Enterprise Ireland, particularly your development advisor, is going to be able to help. He can put you into contact with all those people. So, I mean, the one thing that a lot of people come to Enterprise Ireland looking for grants and looking for this, that, and the other. You know, the reality is we're the advice and the softer supports actually make such a bit more of a difference. Actually, that leads me to my last question for you before I'm going to jump onto the Q&A. You might just talk about your experience about engaging with Enterprise Ireland, and don't sugarcoat it. Give us the good and the bad here, you know, just for everybody to know it. Obviously, I prefer if you gave more good than bad, but be realistic so people know what to expect. Yeah,
so I've had a very positive experience with Enterprise Ireland. If I'm honest, when I started out, if you had have asked me the same question, I might have given you a different answer. But I think looking back on it, we were engaging with Enterprise Ireland the wrong way. So since we've started to engage with our DA properly, speaking regularly with our DA, informing our development advisor of all of the various projects and initiatives, new hires and so on that we're working on, it's allowed our DA to tailor the supports to us a lot better, essentially. So I suppose when I was trying to start the business, we were also applying for HPSU funding. And I found at the time that we were spending a lot of time, you know, going through the funding process and not enough time focusing on the company. But I think as we've grown and as the team has built, and as more people on my team, not just myself, are engaging with EI, you know, it's been a really strong partnership, and that's how we look at it now, as a partnership. So everything from our HPSU funding to, we've got key manager grants, we've got the Leadership for Growth course that I touched on earlier on, which was really transformative for the business. You know, it's been very positive, and just want to say thank you to you guys also just for your support over the years. Okay, brilliant. Well, look, you're not over yet because there's a lot of questions coming in from the floor. But what I might do is invite Jonathan Levie to come back onto camera and to screen. And so any questions coming in from the floor, but I see a couple here and I'm going to ask them. And of course, Owen, you feel free. There's a lot of questions coming in. So if you can
pick out some pertinent ones, pop on screen, and I'll see, and I can throw over to you. For yourself, Nick, who wrote the systems and processes, and how did you correct them would support your growth?
So the functional heads essentially were involved in that. It's really just about mapping what generally speaking, we found that the further away you got from the founders or the senior leadership team, that's when things started to break. So it was about the senior leadership team codifying how they do things, putting that into standard operating procedures so that can be communicated and distributed through the organization, and then people can follow those processes. Sounds really easy. It's extremely difficult to do, but that's essentially the essence of it. That's what we try to do.
Okay, all right, very good. Jonathan, in relation to yourself, sorry, Owen, I see you there. You ask a question.
Hi, Tom, and thanks, Nick. Yeah, so there's been a number of questions that are coming through the panel, which is great. There's a lot of interest in Neometric's journey, Nick, and Tom's touched on a couple. So going down the questions, so Anthony Cahill has asked the question, I suppose, around your investment pathway, and is there a reason that you went through the debt route rather than down the VC equity route, and did you explore external investors as part of that strategic thinking?
Yes, that's a good question. So absolutely, we explored the equity route, but the businesses that we're buying are profitable, cash flow generating businesses. So we don't need to take on external equity. We can essentially buy a company using debt, and those companies will repay a loan that we use to acquire the business. So when I started the company initially, when my equity wasn't worth anything, we tended to give it away for free. We were very, very loose with how we managed equity and giving equity away. As the business has grown and matured, we've become a lot more protective of equity, obviously, and we've learned from those mistakes. So I'm very reluctant to give up equity unless I have to give up equity. And if we can fund through other means, if we can fund through debt, and if we can do that safely and reliably, then there's no reason for me to give up equity when we can just use other sources of funding.
So, Jonathan, I might ask you a question here that's come in from the floor. Like, you obviously seen an awful lot of these scaling companies that have done this, and you've listened to Nick's journey. Like, is there a lot of similarities, or what are the key messages that Nick is coming out with now that you would recommend other companies follow?
Yes. So one of the things that I take away is that if you haven't done this before, you don't know, just as Nick said, what you don't know, and it's very hard to anticipate how things will change, because this is exponential growth. It's not like linear growth. So before you know it, you've got this wall of water in front of you. So one way of figuring out when you need to do things is to link to people who have done it before. So you can either build this network, as Nick has done with other CEOs who have done it before, or who are a couple of years ahead. But you can also hire functional heads who have done it before and listen to them. So I have a PhD student, Sarah Bowen, who's interviewing a lot of what we call serial scalers. So these are functional heads. And one of the things they say is that it can be quite difficult to get heard by CEOs who haven't done it before. So CEOs really need to sit down and listen to what they're going to face in the future. These serial scalers know what they're going to face, and they know when to put in the scalable processes and systems.
Well, actually, that leads me nicely onto the next question, which sort of applies. I'd love to get an answer from both of you on it. So, Jonathan, since you're speaking already, I'm going to ask. One of our guys actually asked here. Which would you recommend you do first? Spend a lot of time on getting all your scalable processes in place from day one, or do you just jump right in take action and make things happen and fix them on the fly?
Yeah. Well, I mean, again, I think it comes back to if you've got people with serial scaling experience, they will know when those processes and systems for scaling need to be in place. They may not actually need to be in place at day one. When you're starting up, you're still searching for that, viable business model, and you're needing to change things on the fly. There's a relatively small number of people. You're all communicating with each other all the time. And that brings me back to my point about internal transformation. So once you've found that business model that works, once you've got product market fit, then you need to start preparing the business for scaling, because the more people you bring on, before you know it, there'll be people coming in the front door who you've never met because you didn't hire them. So how do they know how to behave? How do they know how to do the right thing? That's the point at which you really need to have those processes and systems in place, and also have this kind of culture management system that makes sure that people know where the business is heading, what its purpose is, and how to make the right decisions when you're not around, when their manager isn't around.
So Nick, how does that resonate with you? I mean, did you go at it in terms of on the fly, or did you actually, like sit down and map it out, or was it a point where you went, Jesus, things are starting to get out of hand here, we just need to sit down?
Yeah, so there's an old military saying that no plan survives first contact with the enemy, and I think you can spend a lot of time planning instead of doing, and I think that is the fear here. Like, you need to obviously look forward and anticipate what's coming down the line, but I'm more of a fan of getting started, and then as you go, you'll figure out what needs to be fixed and improved. Of course, if you have somebody on your team who's been there and done that, and they have the foresight to say, we're going to have this problem very quickly, of course you have the foresight to put those new systems and processes in place. But we didn't sit down with a crystal ball and predict what was going to break in the next 6 months. You just kind of get going, get stuck in, and then you'll know pretty quickly what you need to improve. One of the things that helped us along the way, we introduced a system called the Entrepreneurial Operating System. Not sure if you've ever come across it, but it's from a book called Traction, and it's a set of tools that growing businesses can use to essentially grow their business and manage that growth. So I'd recommend that to anybody listening out there. That just gave us a framework to build upon, and then as we came across challenges and issues, we were fixing them as we go.
Just Tom, I might just come in here, and I suppose there's a theme coming through in some of the questions, and I suppose, Nick, it reflects Mealmetrix' growth journey, and specifically the growth through acquisition. So the question from Pat Gary in the chat is, do you have a model for how you value companies you purchase? Is it a multiple of revenue? But I might just also broaden that out and just say, for companies that are considering growth through acquisition, what would you see as the key considerations and maybe the best way to go about it?
Yeah, so businesses are valued in different ways depending on the type of business and the industry and so on and so forth. So the companies that we're acquiring are profitable, they have strong EBITDA margins, and so we are acquiring businesses on a multiple of EBITDA. Other businesses, if you're acquiring SaaS businesses are typically sold on a multiple of revenue, for example. So it really depends on the kind of businesses that you're acquiring. But to answer the specific question, yes, we do have a model. We have certain parameters that we will use to value businesses. It's kind of a evaluation process that we're comfortable with, that we feel supports our investment thesis. And we have kind of worked and developed that over time. So I think it's important when you're looking to grow through acquisition that you're really clear on the type of businesses that you want to acquire, and that you devise a funding approach that supports that. And if you're like us and you're acquiring the same kind of businesses over time, you can really refine that model, and you get to a point where you can review, evaluate, and essentially acquire companies in a very efficient way.
Okay, excellent, excellent. Guys, we're coming very, very close to time, so I'm going to ask you is almost for two final or a final thought of the day, for want of a better word. But we might be quick on it. But Jonathan, just if companies that are going through rapid growth rates, they're looking to scale, what would you give them as things to be aware of and things to do, a piece of advice?
Okay, so imagine you're paddling into this huge wave. You're being raised very gently at first, but then the slope changes and it keeps changing, and before you know it, you're up against a wall of water. So you've got to prepare for that. And I would come back to that flywheel of the three things: the culture, the processes, and the systems for scaling. Failure could happen through any one of those three. So you really have to keep looking at those three and making sure that you're getting the people on the bus and they know where they're heading, and they can do things without you, make the right decisions without you, and that you're getting the information you need to be able to, recognize those snakes in the leaves before they bite you.
Okay, and Nick, and I'm very sorry, there's been a ton of questions that have come in, and we tried to consolidate and answer them all as much as we can. But Nick, maybe final thoughts to you, and maybe even just add in one last piece, which is, how did you attract the right people to join you on your scaling journey in your company?
Mm-hmm. So just to agree with what Jonathan said, I think the most important thing is to ensure culture is very clearly defined, your core values are very clearly defined, and as you start to scale, that you're hiring based on those core values, and ultimately firing if people don't align with those core values. Because as the team grows, you can't be involved in everything, and you need to ensure that you have people on the team that are aligned with the values of the founders or the senior leadership team, so that as they're making those decisions themselves day to day, they're more inclined or more likely to make the same decisions that the senior leadership team would. In terms of finding the right people, it's difficult at the start. It gets easier as the business gets a bit of scale and gets a bit of notoriety, for example, because people want to work somewhere that's fast growth, that's getting media coverage and so on. It makes it a lot easier to hire people. But for us, it was just being clear about what the vision was, what we're doing differently, why it's an exciting place to work, and ultimately people want to work in an organization like that.
Okay, all right. Well, look. What I want to say is thanks very much, Nick and Jonathan, for joining us today. Hugely appreciate the time and effort. Look forward to continuing to hear the Mail Metrics expansion story. I believe you're going to take over the world soon enough. So
after lunch.
Yeah. So thank you, guys. So look, that just leaves me to wrap up in terms of today's session. I hope you found it as interesting as I did. The next session is on the importance of planning to achieve scale, right? So this is the second webinar in this series of 5, and it's going to focus on the need to actually create a scale-up plan, okay? And as Benjamin Franklin said, fail to plan, plan to fail. Companies face loads of challenges when they scale internationally, and you really need to understand all of those problems well in advance. So, as they say, a stitch in time saves 9. Right, all too often companies get caught up in the day-to-day and that they fail to achieve their true scaling potential. So this whole webinar is about the need for you to create a clearly articulated plan. And just to fit a third quote in the last minute, as Nick mentioned there, plans fall apart, first contact with the enemy. Well, similarly, no business plan will survive first contact with a customer. So, but it's really, really important to actually do the plan, and more importantly, on how you execute on that plan. So Paul O'D, he's the Managing Director of Select Strategies. He's going to be our expert speaker next month. He's co-founded and scaled several tech companies. He's written books on how to scale a business, and he now works with several of our clients on their scaling journeys. And we're going to be joined by Mark Barrett, who's co-founder and CEO of APC. very, very large company, and he's going to share his growth journey with us. I mean, Mark founded APC in 2011. The company now employs 300 people, and there's a plan to scale it to over 600 in the coming years. So that webinar is going to be on the 27th of April at 10 a.m. So that's the 27th of April at 10 a.m. So that just leaves me to finish up. Once again, thanks to everybody who joined us online. A special thanks to Jonathan and Nick. Nick, particularly because I think it was like 5 a.m. for you over there. So thank you again for joining and taking the time out to us. And again, I'd like to thank the team, Roisin, Jane, Brian, Owen. You've made it all quite a success. So for any more information on this webinar, or to see the others webinars that we've coming up and to register for it, I'll ask you to go to the globalambition.ie. It's a webinar series, Building Blocks for Scale. We'll put the link up there. So again, this webinar and the slides will be available for everybody. So thank you again today, and good luck.